Now we proceed to the transaction on January 9. January 9, we have purchased supplies on account 7,000. So again, we go back to our identifying purchase of supplies. So obviously, one of the accounts affected is supplies. And again, when we talk about supplies, it is still unused at this point, and therefore it is an asset account. So again, this is the same with insurance. This is a form of prepayment, and when we discuss the adjusting entries later on as one of the major topics also, we will be learning two options to record this one. But again, for the meantime, we will just satisfy our needs to understand journal entries, and therefore we'll simply have to use the simplified approach of recording this transaction. So anyway, it is clear here that supplies is acquired, and therefore supplies is an asset account and is one of the accounts affected in the transaction. So another part of the transaction is that this purchase was done on account, so meaning on credit, no cash was paid. But instead, the company will have to pay it sometime later. And therefore, since the company has the obligation to pay, it must recognize a liability account. And the account title appropriate to this would be accounts payable. And again, because the company acquired supplies on account. Of course, another account title that might be used is also notes payable. But why is it that we use accounts payable rather than notes payable? It is because the company did not issue a promissory note for this purpose. So once a promissory note is issued, for example, then instead of accounts payable, the more appropriate account title would be notes payable. So since this is simply a verbal promise to pay, then we will have it accounted as accounts payable. So again, supplies, an asset account increased because we increase our supplies by purchasing supplies, and accounts payable, a liability, also increased because obviously now we assume another 7,000 liability because of this purchase on account, which is to be of course paid sometime later. So this is clearly an accountable event. And of course, before this transaction, the asset, liabilities, and equity have their balances. But after that, as I have said already, supplies increased from 0 to 7, and accounts payable with a prior balance also increased by 7,000. So if we present them in a table, here's how it looks. Assets increased by 7 because of supplies, and liabilities increased by the same amount, 7,000, because of accounts payable. The transaction did not affect owner's equity, therefore it is 0. So again, asset is equal to liabilities plus owner's equity. 7,000 is 7,000 plus 0. So as I have said, the equality of debits and credits and the equation asset equals liabilities plus owner's equity, the equality is always maintained. So of course, from 0, the supplies increased to 7, and accounts payable is increased by 7. So using the normal balance, we will increase supplies by debiting supplies, and we will increase accounts payable by crediting accounts payable. So of course, just to summarize that, supplies therefore should be debited for 7, and accounts payable should be credited for 7. And to convert that in an entry, we have it here: supplies on the debit, accounts payable on the credit. Amounts are both 7,000, and our explanation can be as simple as purchased supplies on account. Okay, so that is our journal entry for transaction on January 9. So now we proceed to our transaction on January 15. January 15 is the time when the company paid salaries with the following deductions. So if you remember, we have a transaction on hiring. The hiring of employee cannot be converted into any of the elements, but the payment of the salaries or the accrual of the unpaid salaries can already be converted into the elements of the financial statements, and therefore salary payments or salary accruals are accountable events, unlike the hiring of employee. Both are important, as I have said, but the hiring is non-accountable, while the payment of the salaries are accountable events. So we have here the gross salary of the employee, because the employee is paid every 15th of the month. Gross salary of 4/5. We have the deduction for SSS, PhilHealth, HDMF, and all with a sum of 250. So the net pay, or the amount that is to be paid to the employee, is therefore 4,250, because it is to be reduced by the employee's share in the contributions. Again, we have 4/5 as our gross, but the net amount to be received by the employee or to be paid by the company is only 4,250. So what are the accounts affected?